when one company gains control over another, and that may be hard to define sometimes, a business combination is formed. And what we're going to have to do is, when we present financials to the outside world, we're going to have to present consolidated financials. We're going to have to combine the financials of the two companies and present them to the outside world. So there are 5 basic ways to accomplish the business combination in the first place. The first 3 are statutory mergers, where the sub, or in the third one, the sub and the parent both get dissolved. And so automatically consolidated financials are formed going forward because we got rid of the sub in 1 and 2, and we got rid of the sub and the parent in number 3. So now all the assets and all the liabilities and all the income statement accounts are all merged into the new entity. The more interesting thing is if we have, say, 50% or more of the voting stock of the sub, and we want to keep it in legal existence. In other words, we don't dissolve it, we keep running it. Maybe they have a great reputation and we don't want to get rid of their brand, we don't want to lose their people. Maybe we think that we can own it for a few years and then flip it and turn it around and make a lot of money. And the 5th one is called the variable interest entity. This used to be called a special purpose entity. It's the devices that Enron used to use to get off-balance sheet financing. And so now if we control an entity through contract or other means, we're going to have to publish consolidated financials to the outside world. So let's try to do a real simple example. This is P. They're going to buy Sub. Sub is a real estate consulting firm that's fallen on hard times. They used to be the darlings of the market, and now all they got left on their books is some land. And so P comes along, and let's say they're going to do a statutory merger. The first instance, they're going to buy the sub and then dissolve it. Well, we're going to use the acquisition method, which means we're going to put the assets on P's books at their fair value. And let's say we negotiate with these guys, and they say, you want to buy our business, you got to pay us $700,000 cash. And by the way, we think this piece of land that we own, it may be worth only $600,000 now, but we think 5 years from now, when the road gets widened, that it's going to be worth $1 million. And so to break a standstill in the negotiation, we said, okay, I'll tell you what. If that land is worth $1 million 5 years from now, we'll pay you another $214,116. So again, we're in the first merger scenario, if you will. We're going to buy these guys and then dissolve them. And we're going to put the assets on our books at their fair value. Well, first of all, let's find out what the present value is of this $214,116 that we have a 25% chance of paying 5 years from now. So let's go into our financial calculator. Let's clear the third row. And 5 is the N, 5 years from now. Our cost of capital is 6, so 6 is the I. We're going to take that $214,116, multiply it times 25%, and that's going to give us the future value. And then we're going to hit compute PV and discover that it's worth, let's round that up to 40,000 bucks. So that contingent performance obligation is worth $40,000 today. We're paying them $700,000 cash. That land has a fair value of $600,000. Remember, we're in the acquisition method, so their assets and liabilities go on our books at their fair value. That journal entry doesn't bounce. What do we need? If we pay more than the fair value of the net assets for a company, that extra bit is called goodwill, that intangible asset that hangs out on our balance sheet, and we'll check it for impairment every year, at least every year. And now we'll dissolve the sub, and all that's left is the parent. And what does their balance sheet look like now? Well, cash is down by $700,000. We've now added some land on our books. We had $100,000 before. We add this $600,000. Now have this intangible asset, goodwill, $140,000, and this contingent liability for $40,000. And please note that there's this convention. When we list a trial balance or an adjusted trial balance in one column, positive numbers represent debit balances and negative numbers represent credit balances. That's going to take a little getting used to, but it's really handy. So that was the first scenario where we buy the sub and we dissolve them, they go out of business. Now let's look at the fourth one. the sub is going to remain in existence as a legal corporation. So they're going to have their own books. We're going to have our own books. And we're going to use whatever method we want internally to account for the sub. But whenever we talk to the public, we have to present consolidated financials. So we're going to have to simulate those. We're still going to use the acquisition method, which means we're going to look at fair values. But we're not going to put their assets on our books. Instead, we're going to have an account called investment in sub on our books. So we still have that contingent liability of $40,000. We paid them $700,000 cash. So our investment in sub has a balance of $740,000. So now what does the parent's balance sheet look like? Well, cash is down by $700,000. Land is still on our books for our original book value, but now we have this new asset called investment in sub with a $740,000 balance, and we have this new liability called contingent performance obligation. And here's the important question. What happened to the subs books? Nothing. Unless we use push-down accounting, nothing happens to the subs books. They're going to stay in business and keep their book values just like they always did. And when we prepare consolidated financial statements, when we simulate these consolidated financial statements, we can't just add things together. So, for example, this investment in sub already includes the book value of that land of $500,000 plus $100,000 write-up of that land plus $140,000 worth of goodwill. So we're going to have to unpack. That investment in sub before we consolidate. So before we prepare a worksheet that's going to simulate consolidated financial statements, let's prepare an acquisition date fair value allocation schedule to figure out what was packed into that thing called investment in sub. We paid them a total of $740,000. That was $700,000 cash and $40,000 in the contingent performance obligation. The book value of their assets, the net book value of their assets, or another way to say that is their shareholders' equity, was $500,000. So the excess that we paid is $240,000. $100,000 of that went to land. Remember, the land was on their books for $500,000, but was really worth $600,000. And so that left us with $140,000 worth of goodwill. So the next step is to create a worksheet to simulate consolidated financial statements. We've got the book values of P here, got the book values of S here. We've closed out the revenue and expenses of sub. We didn't have anything to do with those sales, so those shouldn't show up on our books. We've got our debit and our credit columns here. These are for simulated journal entries that aren't really going to show up on anybody's books. They're just going to show up on our worksheet where we simulate the consolidation, and the last column is going to be our consolidated financials. Let's put these consolidating journal entries in red font so that we remember they don't show up on anybody's books. And let's call this first one S because it unpacks the stockholders' equity. You can call it whatever you want in the real world. We're going to call it S. It unpacks the stockholders' equity. In other words, the net book value of the assets that we bought. So sub had a $500 credit balance in common stock, a $1,500 credit balance in additional paid in capital, and when we closed everything out, remember we didn't have anything to do with their sales for last year. We're buying them on December 31st. Those sales were their sales. Their retained earnings has a credit balance of $498, so we zero it out with a $498,000 debit, and we unpack $500,000 out of that asset investment in sub. Consolidation journal entry A is going to remove the excess payment from the investment in a sub account and allocate it where it belongs. There's an extra $100,000 for land to get it to fair value, and there's $140,000 of goodwill. So again, this journal entry doesn't appear on anybody's books. It just shows up in our handy dandy worksheet, and we can call it whatever we want, but for learning purposes, let's call it A because it allocates the excess. Okay, we're almost there. Let's post simulated journal entry S and simulated journal entry A to our two columns on our worksheet. So what's the consolidated income statement look like? It's the parent's revenue minus the parent's expenses for $50,000. What's the statement of retained earnings going to look like? Retained earnings at the beginning of the parent plus the $50,000 of net income we just made minus $0 of dividends means that retained earnings at the end are $1,050,000. What's the rest of the balance sheet look like? Well, to complete the balance sheet, all we have to do is add across. The cash has a balance of $300,000, accounts receivable $50,000. Land is now on our books for a total of $700,000. That's the parent's book value plus the sub's book value plus the excess that got allocated when we bought the sub. The investment in sub has been zeroed out. We unpacked it and zeroed it out. Goodwill is now on our books for $140,000, and the contingent performance obligation is on there with its credit balance of $40,000. What happened to the owner's equity section? Well, we eliminated the subs shareholders equity sections with our journal entry S. So now the balance is just the parents at this stage. And that's all there is to it.